It's great to have back on the show today Nick Maggiulli, who is the COO at Ritholtz Wealth Management, also founder of Dollars and Data, a data-focused personal finance blog, and also author of the new book, Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. Nick, the book is killing on Amazon. It's crazy what's going on.
I appreciate it. Yeah, it's been a crazy few days so far.
So, one of the questions I often get from my viewers is, are financial advisors a scam? And what I try to explain is at the individual level, no, the answer is no. I mean, sure, there are financial advisors whose practices are scammy, and there's financial advisors that are not. But what I say the scam is that the financial services industry has sold the idea to people that basic personal finance is really complicated and you can't handle it yourself. And what you do in your book is you explain in really clear terms the most important, 8 to 10 principles about managing money. And you really explain that it's not as complicated as maybe the industry wants you to believe. Is that fair?
Yeah, I think that's true at times. I mean, obviously, it depends on your situation. And I think that when financial planning makes the most sense is the more complex it gets, especially with taxes. So, usually, I think for most people, it doesn't make sense to be paying a fee if you don't have a lot of assets. It's very simple. I mean, unless you just want the peace of mind. And so that's what a lot of people really that, I work in the wealth management industry, full disclosure,
Of
but that's what
course.
a lot of people come to us for is for the peace of mind. It's not necessarily like, it's not that they couldn't do it themselves. A lot of times there's like, I don't want to do it. I'm going to spend my time doing something more valuable. And I think that's why for a lot of people, it's worth the price they pay.
One of the things that you talk about in the book, and you back it up with data, is kind of the futility of this idea of when should I be investing? When is the right time to sort of get in and to get out? And this is something I've talked to my audience about a lot. And every time that the markets are shaky, and we saw this in March of 2020 at the start of the pandemic, we've seen it over the last 2 months. So many people, you look at Twitter, you look at Reddit, you look at all these different places, they're saying, I'm going to give it 5 more days, or I'm going to wait, or this isn't exactly the right time. Aside from anyone's opinions about their ability to predict the
Mhm.
future, which is not very good, where humans are not particularly good at that, lay out the statistical case for why it doesn't really make sense to be doing that.
Yeah, so if you're trying to wait, so waiting to like buy a dip is one thing, and then just waiting at all is usually a bad idea. And the reason why is because most of the time markets, generally increase over time. And of course, there's going to be cases where markets crash and things like that. But if you're going to compare someone who's trying to, even if I use in the book chapter 14, it's called "Even God Couldn't Beat Dollar Cost Averaging," and I basically say I'm going to tell you when the dips are, and you're just going to save cash and buy those dips, like the lowest point between two all-time highs, like on a monthly basis. And that strategy actually underperforms someone who's just buys every month, like 80% of the time. And the reason why is because by the time you wait for that big dip, by the time it happens, that dip price is higher than where you could have bought originally, right? So you're always ended up buying at a higher price. And so there's always gonna be reasons to sell. Like you're always can, psych yourself out about this stuff. And don't get me wrong, sometimes people are gonna move to cash and they're gonna be right once in a while, right? And they're gonna be right in the short run. But I think the behavioral reason why you shouldn't do it is you're gonna be wrong in the long run, right? If imagine every time, imagine in after 2009, you're like, wow, I'm going to stay out of the market for a while. 2010, 2011, you stay out. You're like, wow, look, I'm smart or whatever. Markets recovered a little bit, but then you stay out for the next 5, 10 years and you miss one of the biggest bull markets in history, right? And that's what's happened. There's been people saying the stock market's been overvalued since 2012, 2013. The market's been on an upward tear since. So one day they'll be right, but they're going to be wrong most of the time. And that's the issue here.
The other concern I would have with such a strategy, and many of my friends do this stuff, and I tell them, I think you're wasting your time, is that I'm big on systematizing what I'm trying to do with my finances. And even if you believe that you would be really good at figuring out, okay, we've hit the bottom, now is the time to start buying again. It's not a systematic approach. And the systematic approach has the advantages, number one, of being, in my mind, far less stressful and anxiety causing. Number two, if you continue your investment plan on the way down, you're actually getting more value for your money in the sense that $100 buys you more shares when the market is down than when the market is up. And
Mhm.
thirdly, and correct me if I'm wrong, you're continuing to accumulate dividends during that time. And somebody who is
Mhm.
just waiting is not going to be doing that. So it seems that the systematic aspect has both psychological and financial benefits.
Yeah, I completely agree. And so the whole like my argument is like, do something better with your time, right? Like like David, I think you're probably better suited to be, hosting a YouTube show and talking about this than spending,
Right.
5, 10 hours a week looking at your investments, right? If you think about the return you're going to get on your personal human capital, and for someone else that may be like, oh, I'm a photography person, like maybe you should do more photo shoots, or someone, is a writer and so they should write more blog posts, whatever it is, whatever you do, like I bet there's some higher value activity you have than going and invest and doing that stuff with your money, especially if you don't have a lot of money invested. If you have $10,000 invested, right? Let's say you can, increase your returns by, let's say 10%, right? That's $1,000. And let's say you spend 10 hours a week doing that over the course of a year, right? So let's say 10 times, 50, it's 500. You spend 500 hours to make $1,000. Like, think about that. Like, it's so silly. Like, you should literally just get a part-time job. You'd make way more money, right? So it's one of those things when you start thinking about the math on it, you're like, wow, my hourly wage of doing this doesn't make any sense. If you have $10 million, that's a little different, but most of us don't. So
When it comes to debt, there's some interesting parts of the book about, you talk about mortgages, you talk about debt in different ways. Debt is very polarizing, and I don't mean necessarily politically polarizing. I'm not talking about the national debt. I'm talking about personal debt, people's decisions about credit cards, as well as people's decisions about mortgages. And very commonly, you'll hear strategies espoused. If I understand correctly, Christian financial guy Dave Ramsey talks about starting with, I don't remember if it's the smallest debt or the highest interest debt first. Everybody has some algorithm that they will sometimes apply. What's often missing from those conversations are the sort of psychological impacts of having the debt. And so when people sometimes have called, I guess they call me because my background was in financial planning, although I haven't been in that space for 15 years. They'll say, should one pay off a mortgage if you have the cash to do it? And you can run the numbers calculating what's your mortgage interest deduction and what's the interest rate. You can do all that. But at the end of the day, there's an intangible, which is like psychologically, what is having the debt do for your day to day? And that can be much harder to kind of wrap our minds around, can it not?
yeah, I think some of the data on that's interesting. So the only debt that didn't have any sort of psychological impact, at least on average across the population, was mortgage debt. That's the only. Every other debt messes with people. If you have credit card debt, that's usually stressful. If you have other type medical debt, whatever, that usually affects people's psyche. They found that mortgage debt generally doesn't affect people. However, there is a subset of the population that doesn't feel comfortable with any debt, and that's fine. And so you're not going to want to hold debt at all. So even there's people, like I know people very smart in the financial space, and they paid off their homes despite the fact that they had like a 3% interest rate, and they did that because they just want the peace of mind. And so for some people, peace of mind is going to be better than all that other stuff. And so just you have to think about that, when you're making these types of financial decisions. So there's nothing wrong with it, but just you kind of have to know yourself, right? This is almost a story as old as time. This is like a philosophical point that's been around for thousands of years, like know thyself, right? Like, so once you know kind of what you like and don't like, that's how you can make better decisions with your money.
When it comes to timing and real estate, uh, are the principles different than when it comes to timing the stock market, in the sense of, if you have a need for housing, you can choose to buy or you can choose to rent. And very often, rents will reflect the cost to whoever ultimately owns the property in which you're going to live. So there's a correlation there, although it may not be perfect all of the time.
Hmm.
Sometimes people who already own a place say, well, I'd like to move, but I want to wait until the property is worth more. But then in all likelihood, the property you're looking to buy will also have increased in value, unless you've got maybe some market arbitrage because you're looking to move or something like that. How does the timing
Hmm.
piece affect the purchase of property?
So yeah, I think because like so if you're saying like, oh, I'm going to buy like a REIT, right? You're going to put money into like a REIT fund that has, you're owning a broad basket of, commercial properties or whatever, commercial and residential properties across the US. I think timing is not going to matter that much. I mean, obviously there will be ebbs and flows in the market overall. However, when you're buying an individual property, timing matters a lot, because you can, the corollary in the stock market is like going from buying the S&P 500 index fund to just buying Apple. You're buying one individual property is like buying a single stock, right? So you have single stock risk in your individual home. So like, of course, timing is going to matter in the sense that there's a lot more risk when you buy an individual stock or an individual property. So like, there's no real great way around that, right? You're going to have to take that individual stock risk, so to speak, with that individual property. And so like, yes, timing is going to matter, and you're right that like other properties will go up in value too. So you just got to figure out like, hey, is this the right time for me? And don't try to look at it as an investment. I think when you buy a home, it needs to be something more for your personal life, societal reasons why you're doing it. Maybe your personal life's stable now, you have a few kids or whatever, and you know, like, hey, this is the neighborhood I want to be in, this is everything I want, and you just move. And I think if you think about it as an investment, it's going to be really tough for you because your home should not be, I mean, it can be an investment, but you can't eat the equity. Your home price could double. You can't do anything about that, especially if you move to another home, you end up selling that home, buying another one. What did you actually earn? Nothing, right? If all the prices move. So you can't eat your equity, unfortunately, until you do some sort of arbitrage, like you said, like the Californians moving to Idaho and et cetera, right?
So we've talked about stocks, we've talked about real estate, cryptocurrency. Cryptocurrency, there are so many opinions, many of them informed, many of them not informed, many of them misinformed on cryptocurrency. My view on cryptocurrency has been I want some upside exposure there. And so years and years ago, as we've talked about before, I got some Bitcoin and some Ethereum. And I kind of determined, given its volatility, what's the right asset allocation for me. And for me, it's about 3% of my total assets. And so if it goes to zero, I lose 3% of my total assets. At this point, it has grown so much and I've sold pieces of it that even if it went to zero, I come out ahead. But the point is, I'm thinking of the volatility in determining what is my right exposure in terms of asset allocation. Is this the right approach when you are dealing with a relatively new and volatile asset?
Yes, I completely agree with that. I actually I did some analysis and I found like the optimal portfolio had like 2% Bitcoin, and that's basically what my crypto allocation's been. So 2%, some go up to 5, you know. I think that's very prudent. I don't think there's much to add. I think you almost had a perfect answer there. So
Well, let's then go in this direction. There seems to be a sort of moral assessment done with crypto that isn't always done with stock holdings, which I find interesting. Like, for example, when I hold a total stock market index fund, there are absolutely companies in there that are probably not great companies. There's, statistically speaking, there's companies in there that are committing fraud, securities fraud of some kind. There's the full kind of gamut. But I don't find myself emotionally tied to that in the way that sometimes people make very emotional reactions to Bitcoin or Ethereum. What do you think it is that causes some, at least, to view these things so differently?
I think there's just so much fanaticism on both sides. So I think like the pro crypto people are so pro crypto they can only see that way, and most of them I think have like a very, very large percentage of their assets in crypto. It's gone up a lot. So they are going to be biased. And then there's people on the other side who weren't in on it and they think it's a big scam and it's worthless and all this stuff. And they're going to be biased in their own ways. And I think it's really tough to have a balanced view on this because you're going to bring some bias in. I'm saying so I own some crypto. I think I'm trying to do it in a prudent way, but I'm not perfect on it, but I'm probably slightly biased against it only because it's not income producing. And so I kind of talk about that in the book. Like income producing assets should be the bulk of your wealth, which is like stocks, bonds, real estate, things that actually produce income. Now, bonds obviously have done terribly recently, but for most of history, they've been decent. So, there's a lot of talk about reducing bond allocation. So, and that I think makes sense.
Last thing I want to talk about, in terms of all the signals that people can pay attention to, if you have a systematic plan, an asset allocation, and you just do that every month, it seems to me that there would be very little financial news that you would really need to pay attention to in terms of like what's actionable. So let me just throw a few things out there and you tell me whether these things even really matter to the average investor. More and more articles now talk about when the yield curve inverts, it signals a coming recession. That's like one that is out there and it's very popular. Or when the CAPE ratio goes above or below a certain place, it signals that, okay, so all these different things. Aside from whether these are accurate, does it really matter to the average investor if you have a systematic plan? Because I'm not seeing how you would change your behavior, even if some of these metrics were accurate predictors.
Well, so the yield curve inversion is a pretty decent predictor of recession. And so if you actually look at the data after an inversion, like yes, stock returns are lower. The problem is what are your options? You're like, oh, I'll just move to bonds. Well, guess what? Bonds underperform stocks even after yield curve inversion. So like you don't really have a choice. You just kind of have to like deal with a terrible situation. And that's probably what at some point, assuming history repeats itself, it doesn't always. Like the August 29 inversion didn't lead to a recession. I mean, people say, oh, there was a recession, COVID, 2020, but I'm going to argue that the yield curve inversion in 2019 was not predicting the COVID. Let's be honest here. The COVID
I would
didn't even
agree.
exist then. So
Yeah.
you see my point. My point is, though, these things happen and they are predictive of lower returns. Even like higher CAPE is predictive of lower returns, future returns. I agree with that. The problem is, what are your options? What are you going to do? You can try and move to cash in time, but the CAPE's been at 30 since 2017. The market's doubled since then. Like, what you're going to be sitting there, sitting in cash while the market's doubled, and you're just right now you're eating 8% inflation. You're done. So like, you kind of have to just go on this wild ride, and there's no real options you have.
The book is Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. The book is listed at davidpakman.com/finance when you can see my other finance books recommendations. We've been speaking with the book's author, Nick Maggiulli. Nick, always great speaking with you. Thanks.
Thanks, David. Appreciate it.